If you're looking for a crash course on bond investing for beginners, this is the only video you're going to need to watch. We're going to be covering what bonds are and how they work, what are the different types of bonds, as well as how to invest in bonds using Silo, a cutting-edge fintech platform. And feel free to skip ahead at any point in time using the table of contents down below. Let's dive right in. So first of all, it's important to understand what bonds are and how they differ from equities, also known as stocks. When you invest in a stock, you are buying a piece of equity in a real business, making you a part owner of the company. If the business does well and the revenues and profits grow, the business becomes more valuable and the price of the shares goes up too. However, with bonds, you are not buying equity in a company or entity. Instead, you are simply loaning them money. Bonds are issued by companies or governments and they pay a set rate of interest. Now, similar to stocks, the market value or price of an individual bond will fluctuate based on buyer demand as well as other factors like the Federal Reserve interest rates. And the interest rate that a bond pays is going to be based on the borrower's creditworthiness or risk associated with loaning them money. Higher quality bonds from reputable borrowers will actually pay a lower rate of interest, while lower quality bonds from less attractive borrowers are going to pay a higher rate of interest. Now, the bond maturity or the amount of time until repayment is due also has a lot of influence on the interest rate that a bond pays. Bonds with shorter maturities normally offer a lower interest rate as the risk is lower than a longer term maturity. Simply put, if somebody owes you money, there's normally less risk involved if they've agreed to pay you back sooner rather than later. So why do people invest in bonds? Well, the main reason is for diversification, which has the primary goal of mitigating risk from your portfolio. In order to understand this, we have to look at the differences between being a bondholder and a shareholder. As mentioned before, shareholders own equity in a company and they share in the potential successes or failures that a company then experiences. Bondholders, on the other hand, are just loaning money to a company for a predetermined rate of interest, and then once the bond matures, they return your principal or the amount of money that you loaned to them. This differentiation here between owning a part of a company versus just loaning them money makes bonds less risky than stocks, but there's also an important distinction about repayment during a bankruptcy situation. In the event that the issuer of a bond declares bankruptcy, investors holding bonds are much more likely to recover a part of their investment compared to shareholders. This chart from Fidelity helps us to fully understand this. At the very top, you have senior debt holders, which is normally the big banks. Below that, you have subordinated debt, which is where individual bondholders normally fall. In many cases, during a bankruptcy filing, there is still some money left over after paying the big banks, and ordinary bondholders will receive something. From there, you have preferred equity, which is going to be those who own preferred shares of the company, followed by common equity or holders of common stock in the company. The further down this pyramid you go, the higher your risk is of losing everything in a bankruptcy situation and thus receiving no payment whatsoever during their bankruptcy filing. So for that reason, among others, investors will often own a portfolio of stocks and bonds to have less overall risk associated with their investments. And as you get older, that diversification component becomes more and more important. In terms of what percentage of your money you put into stocks versus bonds, well, that comes down to your asset allocation. Most people will consult with a financial advisor on this, but there's a general rule of thumb that many follow called the rule of 120. What this recommends doing is taking 120 and then subtracting your age, and this would be the percentage you would want to have allocated into stocks, with the rest going into bonds. So for example, if you were 20 years old, you would take 120 minus 20, and that would give you 100, or a suggested 100% allocation into stocks. But by the time you reach age 30, if you take 120 minus 30, that would give you 90% recommended allocation into stocks and 10% recommended allocation into bonds. As you get older, say age 50, that would then be a recommended allocation of 70% into stocks and 30% into bonds. Now, as a lower risk investment, overall returns from bonds are lower than the historical returns of the stock market. But when the stock market inevitably enters a bear market, the downside associated with bonds is not as severe as with stocks. Simply put, your portfolio would drop a lot less if you you had a 50-50 mix of stocks and investment grade bonds, which we'll talk about that shortly, compared to owning 100% allocation into stocks. Most of what we've talked about so far applies to corporate bonds, but there's other types of bonds out there that you need to be familiar with. While companies do issue bonds as a means of raising capital, governments all over the world are actually the biggest issuers of bonds. Government bonds are generally looked at as more stable and less risky when compared to corporate bonds, and that's because you're betting on the stability of an entire government. In addition, governments have the option of increasing their taxes if their debt repayment costs get out of control. At the very top of the government bond pyramid in terms of the highest quality investment and the lowest risk, you have US Treasuries, which are considered to be the safest bond investment out there that exist. The only way the US government is going to default on their obligation to repay you is if the United States itself went bust, which obviously is not very likely to happen. But since these are viewed as the safest bond investment out there, the returns are going to be among the lowest out there. So far we've covered corporate bonds as well as government bonds, but there's one more important type to talk about, and that is municipal bonds. These are bonds that are being issued at a state level or by local municipalities such as a small town, village, or even city. Municipal bonds are right in between US Treasuries and corporate bonds in terms of the risk factor. While local governments can increase taxes too, they aren't as sure of a bet as the strength of the United States government. However, these municipal bonds have a unique tax treatment, whereas interest earned is free from federal taxes and in most cases state taxes as well. But this overall benefit does lead to bond yields for municipal bonds being relatively low. For the most part, when people are investing in bonds, they are buying shares of a bond fund or ETF. Similar to a stock ETF, these funds own a portfolio of different bonds, often including a mixture of US Treasuries as well as corporate bonds. This gives you the benefit of having diversification across different types of borrowers, all with different risk associated with them. Bond funds can also offer you domestic exposure, which is limited to the United States, or international exposure, which gives you a mix of bonds from across the entire globe. One of the most popular bond funds out there is BND, the Vanguard Total Bond Market ETF. This fund owns over 11,000 different bonds with an average maturity of 8.5 years. In terms of the asset mix, roughly 2/3 of the fund is invested in US Treasuries or government bonds, with the remaining 1/3 invested in a mix of corporate bonds. Based on the creditworthiness of the company, they are assigned a letter rating, and this is similar to an individual borrower having a credit score. AAA bonds are considered to be the lowest risk, and that's like having an 800+ credit score, for example. Then it works down from there to the AA's, the A, BBB, and so forth. Now, bonds that are rated at a BBB or better are considered to be investment grade bonds, meaning that they are viewed as having a lower risk of default and worthy of investment. Below BBB, you have what's called junk bonds. They have a lower credit rating, they do pay a higher rate of interest, however, the risk of default is higher. That would be like loaning somebody money with a credit score in the 600s. They're gonna pay a higher rate of interest, but there's definitely some risk involved with the repayment. With BND, the Vanguard Bond ETF that I just showed you, all of the corporate bonds owned are investment grade, having a rating of BBB or better. Now I'm going to show you how to invest in individual bonds using the fintech platform Silo. With Silo, you can invest in all different types of bonds, ranging from US Treasuries to corporate bonds. And with the research tools built within the app, it's easy to understand the credit rating and risk associated with a bond and how that impacts the return potential. They also have an extremely simple fee structure, which is a $1 commission per bond. That's it. There's no other markup or anything like that. So feel free to click the link down in the description to follow along with me as I make a bond investment using Silo. The first 100 people who sign up using my link and then create a new account and deposit $10,000 or more will get Silo commission free for the first 3 months. Silo lets you invest in over 11,000 individual bonds, including bonds from over over 2,000 different companies. On the home screen here, we can see our investment portfolio, and this is a demo account that I'm using. If you scroll down here to the income table, it shows you what your daily, monthly, and annual income would be from your bond portfolio held within Silo. In this case, it's $17.21 a day, $516.29 a month, or about $6,200 annually in terms of the interest payments from the bonds held in your portfolio. Below that, it shows you what you actually own within the bond portfolio. So this account owns a mixture of government bonds as well as corporate bonds here down below. If we click on one of these, like Microsoft, for example, this is going to show you all of the different Microsoft bonds that are held within this portfolio, each with a different maturity date. And then you can simply click on one of these to get more information. For example, the Microsoft bonds here with a February 2035 maturity is a quantity of 17. Now, if you wanted to hold on to these bonds until maturity, that's when you would get paid back your money and you would earn the interest in the meantime. Or if you wanted to sell those bonds early, you would simply click on the sell button in the corner and you could sell that Microsoft bond. Now, if we click over here and click on the person icon in the bottom right, this gives you a visual breakdown of your bond allocation within the Silo app. So for example, the big slice of this pie here, 78% of this is in cash. If we click here, we can see about 11.8% is in corporate bonds, and then about 7.3% is in government bonds, and this little slice here is the other category. So this can give you a really nice visual breakdown of your asset mix within the world of bonds. What we're going to do now is click on the search icon at the bottom middle to find our first bond investment. Now, directly below the search bar, you have top picks, which are going to be the most popular bond investments on the platform, but you can also click this button right here to toggle between different sectors. So for example, if we click into financial, we can see what are the top picks in terms of financial companies in terms of investing in their corporate bonds. So let's say, for example, we wanted to buy some American Express bonds. You would simply click on American Express, and the first thing I want to explain here is the 45 in the corner. So if we click into a maturity here that actually has bonds available, we can see that this has a 47, and this is your suitability score. When you open up an account with Silo, they're going to ask you a questionnaire, which is going to be used for this suitability score to determine whether or not these bonds are viewed as a good fit for your investment strategy. And at the very top, you can see different maturity dates for these American Express bonds. For example, right now we're looking at July 2024, but you can click through these and see how the rate changes based on the bond maturity date. And you can scroll all the way over here and go all the way out into 2033, for example, or 2029, where they have bonds available for purchase. The maturity date is when you're going to get paid back from your loan that you are giving out to that company or entity. But in most cases, when you're buying a bond investment, you're going to be buying it at a slight discount to the amount that you're getting repaid. For example, most corporate bonds are $1,000 per bond, but if you scroll down here, you can see the current bond price is $973.15. In addition to that discount, you're also paid the coupon rate, which is going to be your rate of interest, and then these combined together, the interest rate and the discount, give you this figure up top, which is going to be your estimated annual return from that bond investment. Now, you have a minimum quantity of 2 to invest in most of these corporate bonds. So if we click on the plus icon here, we can toggle the purchase quantity. And if we set that to 2, that would be a cost of $1,946.30. But keep in mind, upon that bond maturity, you would get paid back that full $2,000. In terms of the income that you would have from this, it gives you the daily, the monthly, and the annual. So from those two bonds, you would have 30 cents per day, $8.85 per month, or 107.71 cents of annual interest income. If you scroll down here to where it says traits, we can see the bond rating, and this here is a BBB+, which means this is an investment grade bond. But if you're looking to find bonds with a certain criteria in mind, you can click the back button here and then click on this Explore tab, and this gives you multiple filters that you can deploy to look for specific types of bonds. So for example, if you were looking for a minimum coupon rate of 7%, you could set this at 7% and then make sure you're looking for corporate bonds. And at that point, you would click on the Explore button. This led me to finding these Macy's bonds that are currently yielding 7.131%. However, However, you do want to keep an eye out for this little yellow sign right here that says junk, indicating that this is a junk bond based on their credit rating. We can see the bond rating is a BB positive, which is just below the threshold for being investment grade, making this a junk bond. Now, that doesn't necessarily mean that Macy's is going to default on their obligation to pay you back, but it does mean that there is more risk involved with their business, and that is why their credit rating is a little bit lower and the interest rate is higher. But let's say, for example, you were looking to invest in US Treasury bonds. What you would do from here is click on the back button twice, and then at this point you would go back to search and you would type in US, and this is going to give you the different options for the US Treasuries. We're going to click here on United States US bond, and it brings up this page right here, and just like before, you can toggle here through the different maturity dates for these bonds. Now, this type of bond does have a minimum quantity purchase of 5, which is higher than the corporate bonds, which has a 2 minimum purchase. So if we click on the plus button here and toggle this to 5, we can see that would be a purchase amount here of just about $5,230. And again, you can scroll down here to the income section and see how much income you would be deriving in interest. When you're ready to go ahead and make a bond purchase, you're going to click on the blue earn button at the bottom, and it brings up the order ticket. Now, one tip that you might want to take advantage of is clicking on this gear icon and changing this over to a limit order, and then setting your limit price at 1 cent above the current ask price. So for example, the current ask price is $10.46 per bond. If we change that here to $10.46, the order is much more likely to be filled. That's because small orders for bonds are not always filled, but if you set that price 1 cent above the ask on the buy side or 1 cent below the bid on the sell side, your order is much more likely to go through immediately. Once you're ready to buy this, you're going to go ahead and click on the submit button, and just like that, we have placed this order here to buy 5 US bonds. There you have it, guys. That's a full crash course on bond investing for beginners. You now know more than 95% of people out there about the world of bond investing, and you can now use this as a tool for both building and preserving your wealth. If you enjoyed this video, be sure to drop a like, subscribe, and hit the bell for all future notifications. You can click below to watch my video about how to invest in the S&P 500 for beginners, and I'll see you there.